Awesome. Excited to be here, everybody. We have quite the panel. Today we're going to be talking about meme coins and AI agents.
I can't see it.
Terrible joke. No, today we're going to be talking about RWAs and tokenization. We have a really great panel. I'll let you guys individually introduce yourselves. Miguel, if you want to start.
Thanks. Great to be here. Miguel Kudry, co-founder, CEO of L1.co. We're an operating system for on-chain wealth and asset management. So we work with RAs, hedge funds, family offices, and investors, get them all working on-chain and allocating to on-chain products and strategies.
Good to see everybody. My name is Anthony Basilli. I run our tokenization strategy for Coinbase Institutional, and I also look after our asset allocator business.
Hello, everyone. Patrick Barrett, co-founder and co-managing partner of Members Capital Management. We're a tokenized reinsurance fund focused primarily on property cat, cyber catastrophe, and some other interesting things.
Yeah, I'm Keith Burkhardt. I'm managing director and head of insurance at Evertas. We represent the insurance side of the crypto world, and Lloyd's of London is who we underwrite on behalf of.
Yeah, awesome. Excited to have you guys here. Appreciate everyone in the audience. The first place I want to start is I think one of the big issues with RWAs is I think the aperture in which people look at it is a little too small, right? There's so many different categories of RWAs, right? You have debt instruments, you have fiat, you have equities, real estate, the list goes on, right? So out of all of these categories, which areas are you guys individually most excited about, whether personally or through your businesses?
Any order? Well, we look at it from the lens of the investors. And in terms of who we've been primarily getting traction from, it's really the crypto native individuals who have made a majority of their wealth on chain. And this is a very untapped market for the other side of the market that we address, which is registered investment advisors. Most of these advisors are not working with these clients. And so what do these clients need when it comes to just generalist financial planning? Well, it comes down to a lot of tax planning support. It comes down to just managing risk. And so we tend to look at a roadmap of tokenized assets that looks a little bit different than what these crypto native individuals are actually invested in or where they make much of their wealth. But there's a roadmap. So on the crypto native side, we are going to continue to see more stable coin products and yield generating products. On the tax planning front, we're pretty excited about really tax-advantaged products that get tokenized. And then moving forward, the vision, of course, is all assets get tokenized, and advisors are going to be able to manage them from a single place. The question is, what happens first? I think we have to kind of see the market play out, and kind of hard to tell where the puck will go on the more traditional front. Yeah.
I'll jump in. If you think about the market structure, and that's what we're talking about when we talk about tokenization right now, it's all about how is the market structure forming on blockchains to deliver today what is crypto and what is increasingly becoming more active strategies within the space to eventually become how do you serve all kinds of financial services directly to consumers in their wallet, and how do you allow those assets and those services to run on blockchain rails? Because this is the question we're asking. And so within that, from my prior life when I was at BlackRock and now at Coinbase, it's kind of the same conversation, which is like, what does your customer need? And over time, our expectation is that more and more financial services are going to be delivered through a wallet, will be powered by assets that move on chain. And eventually, it will be that you're going to have your traditional portfolio construction process that will be available. So you're going to have equities, you're going to have fixed income, you're going to have tokenized private markets, which now have liquidity and have new features. And then you're also going to have some crypto and Bitcoin and other things in there as well. So what we expect to see is an expansion of the asset classes coming on chain. We're going to introduce, and so this the big one today, that if you say what is an RWA, a stablecoin is an RWA. It's a digital dollar that moves on blockchain rails. There are close to $200 billion of them in that product category, and they hold T-bills, right? So you have a real world asset on chain. That product has now done $20 trillion of notional trading volume so far this year, and we continue to see the extension of that into tokenized money market funds. I'd say from an asset class perspective, the real estate and the private credit and other things, they've actually been tried for quite a while now. And they continue to grow in breadth, which means there's more and more new fintechs that are emerging and building on chain. The ones that are going to be successful are the ones who have gone through licensing in the appropriate jurisdictions. And I think what we're going to see is we're going to see a continued specialization by those platforms, where they get better and better at bringing a particular asset class on chain. And it might be an unlock because of their specialty and their background or the jurisdiction that they operate in. But we're starting to see this emergence of new products coming on chain across all asset classes. I'm really excited about today just tokenized money funds. I think you're going to hear more about reinsurance, something that I've been pretty passionate about as well. But there's every asset class, to answer the question, is going through this digitization process to be available in a wallet.
Well, thank you for teeing me up so nicely. Yeah, clearly, the area that we are most excited about is the insurance space. We're focused on reinsurance, which is a particular tier of the space, but really, the roadmap over a fairly long period of time builds all the way down to the consumer level. But the part that makes us excited is, it's not pure financialization that we're focused on. It's really solving an issue for the insurance industry as well as, the investor base. If you look at insurance, it's very capital constrained, and as you can imagine with climate change and the various global challenges, there's an incredible need for new risk capital. Some predictions are like 10 trillion, by 2030, just to give you a sense of how big that need is. Whereas, on this side, you're kind of, with digital assets, it's a new sort of emerging pool of risk capital, but it's also an investor base that, as Anthony mentioned, is relatively constrained in its investment opportunity set. You've got sort of volatile things on one side, and you've got sort of tokenized money market funds on another side, but you're going to see this specialization of things like our fund focused on reinsurance or insurance-linked securities, however you want to call it. Very specialized in an asset class and bringing a particular type of asset to investors, which is good for them and for those taking portfolio strategies. It's an uncorrelated asset. That's sort of its little niche. And you're just going to see more sophistication building on this side. But what it's doing is also solving a problem for a real world problem, which is lack of insurance or underinsurance or this big insurance gap. So that's what we're excited about.
Yeah, in our space, well, you really took my thunder. But on our side of the space, a couple things we're seeing. There is a tremendous friction in the insurance industry in just processing. And we see the blockchain as a real opportunity to make the customer experience a better experience. And when you look around and you walk in, just ask the CFO of a company or your mom and dad the next time you say, hey, can you pull that insurance policy out? And it's buried in some place far, far away. And then, so the convenience, as somebody was talking about wallet structure, ability to pull it right then and there, that is really intriguing. It also is an opportunity for the consumer to actually be better at what they're getting out of insurance. And it also takes the time to go on risk and off risk much quicker. And we think that's an exciting part of it. Challenge in the insurance industry, I represent Lloyd's. We have a lot of capital, but the way this asset class is going up in value relative to fiat, we're going to be quickly needing our friend here to my right to come up with great ideas that are accepted by various regulators to be able to service the RWA.
Yeah, I think that brings us to kind of a really good point, which is I think one of the biggest criticisms that we see of RWAs is we already have access to all this stuff, right? We have access to money market funds. We have access to insurance. And so for those in the audience, or maybe more generally, what's kind of the pitch that you would give on the importance of tokenization? Or what are the real unlocks that you guys see that it goes? Yeah, Miguel, if you want to start.
Sure. Well, I talk to financial advisors. This is what they do every day. And I recently had a conversation with a Midwestern RIA who has 6 different custodians because he wants to cover a wide range of asset classes. And I mean, it is incredibly expensive to maintain kind of the operational overhead of dealing with 6 different custodians and managing, investment portfolio models with all of these different pipes. He was like, I mean, I see crypto and I see it as an opportunity for me to remove all of those hurdles. And as Anthony was referencing, in the future, you're gonna deliver these services directly to your clients' wallets. And so this is what this advisor is envisioning. And actually, that's actually possible today. We have the infrastructure. So what's going to happen is you have these products and services traditionally, and all you're doing, moving them on chain, is making them 10 times more efficient. You're turbocharging them with liquidity that works 24/7. You can make changes to your clients' portfolios and allocation models on a Sunday night and do hedging in real time. And so, I mean, at that point, it's just a no-brainer. Everybody's going to switch. So it's not that you can, basically the new platform is just so much more efficient than what's available. Then ultimately it'll be just a no-brainer.
Yeah, I think there's a couple assumptions in there, in that the products that come on into blockchains, they don't start with liquidity. Right, you have to let markets emerge and grow around them, which means they need to be listed on certain exchanges, or maybe there's decentralized exchanges they can participate in. That requires, if it's a security, requires certain licensing requirements. There's a lot of legislative and market structure things that have to still come together for tokenized products to look and act just like crypto. But that's the vision, right? The idea is that because crypto is so fluid and easy to use and programmable and interoperable across these applications, if you can bring the traditional market assets into that realm, then they should also inherit the properties of how this market structure works. So, but we have to get to that point. We've got to work with legislators on how do they handle securities licenses, and how do they have protection from a supervisory responsibility. There's a whole lot to do there. But Miguel's right, like the advisors and the investors that we work with are increasingly very long crypto. Right? They're increasingly doing more in their wallet. They're increasingly going, especially what skews young, right? But this is the largest transformation of wealth that we will see, and it's going from baby boomers to the younger generations, millennials and Gen Zers. And they're going to be like, no, I'm used to this fast digital programmatic stuff, so I want this stuff in my wallet. I'm not going to go use a legacy platform. So that's what we're doing. Like, you have to serve them where they are. And this is actually, it's a savings conversation, it's a retirement conversation, because then you get into how do you start to educate and ensure that young people are passionate about retirement and savings. Like, you got to deliver them products and services where they are, to make sure that they understand that they still need to invest and they can't just be long crypto. So I think it is a function of, like, there is demand. It's a market structure gap right now that's a ceiling in terms of how these things can really roll out. But the efficiency is there. And I'll steal that. Tokenized money market funds are really interesting. So digital asset stablecoins, they can move instantaneously around the world on a blockchain without any blockers, right? There's no correspondent banks in the middle. I can send it to you just like I can send a WhatsApp or a message. Imagine doing that with a stock or a money market fund or some other asset that you owned, right? We do it now with NFTs, stablecoins, and crypto. And we're going to increasingly start to do it with other assets. And then people can then choose, I can send you any kind of asset that I want. I don't always have to settle things in dollars. That's a really big unlock in terms of behavior and how money moves around the world. It also, for institutions, allows them to start thinking about, today, they keep a money market instrument in one bank, and they go to another bank and they say, I want to go add leverage. And the other bank goes, well, sell your money market instrument, move it over here, and then I'll give you leverage on that asset. They can't do any cross-margining, generally speaking. They have to actually move cash from one institution to another. When you bring these on the blockchain, it allows for 2 applications to see and work together. Also, you talked about 24/7 trading. You can, for money market instruments, as long as there's like an AP market structure around it, just like ETFs function, that are there to trade for 24/7, you can have money market funds that also trade 24/7 on the weekends as well. Yeah. Right? So it does start to act just like Bitcoin does, right? Where we check our phones on the weekends. Yeah. because we know we can trade. And you're going to eventually see that for tokenized funds as well.
Yeah, I think you bring up a good point there, which is like the velocity of money, right? And the velocity of really just any asset, right? And I think we've seen this historically. Every time we decrease barriers and the velocity increases, we see capital gains and capital efficiencies come across the board. And so I think that's exactly what it is, right? It's like the lower the barriers of movement, the more all of these asset classes are going to proliferate, definitely.
Yeah. Yeah, I mean, I would just say as well, as is said on literally every panel, is it's just so early. You know, and the more you go into it, the more you realize how early it is and how much work remains to be done. So, yeah, of course, there are criticisms, but if you can just look a little bit longer, the logic of it quickly becomes clear. You know, it also just really depends on the problems you're solving, and every industry is different. You know, for us, you know, we're bringing a new asset class to investors, and there's just certain investors. If you're talking to crypto native investors, it's a non-starter really, that they're not accessing, you know, in a digitized way. We've also found that there's a whole pool of money that the reinsurance world at least is not tapping, or put another way, that these investors don't have access to. And when you go talk to them, you know, we're bringing them something new, something that they want to put in their portfolio, so it's already interesting to them. You know, you kind of have to bring something to the table more than just a kind of, you know, interesting and efficient future. And I think it represents two things. One is democratization, which they really like, and these are not necessarily retail investors. These are, you know, family offices of varying sizes, as an example. It represents democratization, but it also represents, I think, for a lot of them, it's kind of them dipping their toe into digital assets in a way, which is, you know, not to be poo-pooed. I don't think it's quite interesting to them. Maybe they have Bitcoin, maybe they are tech founders, maybe they have, you know, various exposures to it. Mm-hmm. But still, I mean, we have to admit that many people are still very new to this. It's very, very early, and so, you know, finding ways for them to come in, you know, we are finding that traction. It's just really interesting, this proposition. People are bringing tokenization to them, and that's where I think, you know, it will start to get its real traction.
Yeah, Patrick, if we're still early, what inning are we in?
What's that?
If we're still early, what inning are we in?
Oof. It's like we're still putting our uniform on, perhaps. Yeah.
Early stage locker rooms.
Yeah, that's right.
You know, I'm going to take a little different tact. I'm going to take it from a counterparty side. What I think is really interesting to me is in the insurance industry, we do insure the traditional system and the regular assets, and the accuracy rates and the consequences of those, we end up paying the claims on. So let's just take somebody like the SWIFT system versus not the SWIFT system, okay? And you take a look at the accuracy rate, they're off 7%. Within our world, it's 1%. So we look at that as a wonderful opportunity of really compressing the risk issues that can be surrounded. You send the asset to the wrong space. Take title insurance, similar aspects of trying to track the data, do the data. Now you have a claim. How do you get at it? And it is archaic when you go through a claims process. Whereas what I see in real-world tokenization is, of course, that you get the opportunity to look at it like instantaneously. It's all right there, and you can find out where it went wrong and pay your claim, and you move on. So that's how I see it.
Yeah. Switching gears a little bit, I think I see two big barriers to scale for RWAs, right? And typically it's like regulatory and technologically, right? So I'd love to get your guys' view on what are the biggest barriers that you guys see on a regulatory front, and then also on the technological front. What are the biggest barriers that you guys are seeing in those two areas to scale RWAs? Should we kick it off on that side now?
Everything. You know what? Actually, I'll use the term enterprise risk. Okay, so if you're a firm in this space, you really have to button down how you bring things in and out of the space on technology. Who's responsible, who's accountable, what's your due diligence in bringing that process in, okay? On the regulatory side, it is all over the board. Mm-hmm. So know your jurisdictions, pick your jurisdictions, don't be all things to all people. In our space, we tend to really understand when a regulator is involved, we're working with them I've been on the phone with a variety of regulators and say, well, how do you come into play? And I said, your number one real problem in scalability is people. It's the people factor. It's whether they make mistakes. If you got the wrong people involved, it's a black mark on the technology. So everyone can, one bad actor can ruin the reputation of the space. And so that's where I think that the challenges are. And I get to insure those, and I'm putting up a few $100 million every time we do look at that. So it's quite an onerous process. But that's what I see as the barrier to entrance. That's actually more the people side.
Yeah, I mean, I'll give a specific example. There are many challenges, I guess. But just to give a specific example of what could make innovation in insurance really interesting is, if stable coins become, institutionally adopted to the level that your Swiss Re's and Munich Re's are very comfortable facing them as collateral, as using those, on the payment rails. And at the moment, there's certainly an understanding around stablecoins, or an awareness of stablecoins, some understanding, but there are, frankly, regulatory challenges, relating to how that impacts their own credit ratings when that's on their balance sheet, their regulatory capital requirements, and so on. And so in some ways, the tech is there, and they understand it, and they can see the vision of it. They almost want to do it, but they're prevented from doing it for sort of economically, inefficient structures for them as it stands now. So, I think, as with many of these things, it's kind of a slowly, and then it just feels like all at once there's an adoption. And, for us, our view is, in the insurance world and reinsurance, it's obviously a very conservative industry. It's you could even say it's proud of its resilience to being disrupted, right? Like, if just as a random tidbit, the two biggest reinsurers in 1900 are still the same ones as today, and that's Munich Re and Swiss Re, which is, tells you something about the industry and its approach to risk management. And that staying power is not something you see in most industries, right? It's quite remarkable. So you can just expect they're not going to jump into this headlong. But I think as you knock away these barriers that you don't expect at first, but when you dig in, you realize that there's this little inefficiency that they're just not going to do this at scale yet. As we slowly chip away at those, and part of it's just comfort, quite frankly. It's getting credit ratings agencies, and Coinbase has done some great work with us on trying to solve problems like that. Those are the things that you'll knock away, things that aren't that sexy and things that aren't that, in your face, people don't really see. And it just depends on every asset class as well. It's going to be just different things.
You're going to see from a regulatory perspective too, in the United States, if and when the stablecoin bill gets passed in whatever form it becomes, that's going to be a big unlock, right? And so you're going to see crypto regulatory reform over the next few years, right? That's going to be a major unlock for institutions to come in. They've already started though. Like, you have to imagine one of the challenges for reinsurance is that they can't keep up with inflation, and they can't underwrite, and they don't have enough capital. Right, so every year it's $1 billion, and then it's 5, and then now it's 10. Depending on the type of storm that comes in and impacts. If we're talking about weather-related events, cyber is dramatically underfunded. Right, we haven't even started talking about smart contract risk. Right, where now we have $3 trillion of exposure on blockchains, and
that's 25 million in the marketplace.
It's a couple bucks, right?
Yeah.
There's more bubblegum wrappers in the world than there is insurance for cyber risk.
And there's another interesting thing as well, which is, the risks that get covered in some way, are tied to the type of capital that's backing it. Certainly in the ILS portion of the reinsurance market, and when it's pension funds and endowments, right? And they've got comfortable with reinsurance, over a 30, 40 year period of time, and for them it's an uncorrelated asset in their much larger portfolio. They don't really need that to be further diversified from property catastrophe, which is where it's mostly focused, into an area like cyber, which desperately needs money. So there's all these really interesting opportunities when you unpack. But what's really cool, I think, about tokenization and bringing digital asset investors in is they innately understand cyber. Right? There's not a sort of just this fog of I don't know what I'm underwriting, so I'm not going to do it. They can much more easily understand the opportunity, and we think ultimately crypto-related risks. It's really a part of cyber, right? And in 10 years we probably won't talk about the two different things. It'll just be cyber.
I want to make two comments. One is that yes, you hear billions, okay, but the way underwriters do work on the risk is they look at probable maximum loss. So you take a Coinbase and you say, well, what's the average size transaction? And you say, well, how many assets are moving at any one point in time? And when you start diving into it, you find that, well, all these billions is just a couple 10 million or 5 million at any one point. And because of the way the technology works, it's pretty easy to catch what you got, and you're not going to have everything go out the back end of it. So actually, the loss ratios, I'm making good. The loss ratios are strong based on that. Okay. The second side, I think that's really interesting, is that the participants, the builders themselves who are building the balance sheets based on this technology, are likely to become the new insurers. Okay, and the traditional insurers are likely to be able to bridge with their limited capital and with all of their regulation. And for those, there has been a company called Nexus Mutual. I'm sure you've all heard of him. He's a great guy. He and I will sit and chat all day long, and we talk about it. But that approach is actually protected away from the regulators in the sense of how they want to operate. And I think the industry is going to need to begin addressing those risk issues more on their own than just the insurance. They have to use insurance like a bridge or what we call time and distance.
I'd like to think of challenges in terms of a paradigm shift from a regulatory and technology perspective. It's a shift in trust. Traditionally, we trust entities to hold our assets and trust that we'll have our money when we need it, and trust that they'll be true fiduciaries, right? And crypto completely shifts away from a trust model to a trustless model, and nothing more core to that than custody. Self-custody truly embodies the trustless nature of it, because you're not trusting anybody but yourself with your assets. And I think that's something that, from a regulatory perspective, regulators are not very comfortable with. It's hard. It's just never been done. You have a whole industry built on top of walled gardens that hold trillions of dollars and tell you what you can and cannot do with your money. On the technology side, as a builder, you're building a new financial set of rails that are fully transparent, that anybody can look within and see what's happening, because it is trustless. You're not trusting anybody to do the right thing, whereas traditionally, you don't really know what's happening behind closed doors. You just hear about billion-dollar fines from time to time, but you don't hear the good stuff, right? In crypto, everything is out in the open. So I think those are the challenges that kind of go hand in hand, especially as you're building some of these new products and services.
Yeah, definitely. Unfortunately, I think we could have kept this conversation going quite a bit longer, but that's all the time we have today. So appreciate you guys for joining me today. Appreciate you guys for listening, and yeah, thank you guys for the time.
Thank you.
Thank you.